Hello ladies and gentlemen, welcome back. You are still with Everest for this Apatech TV. God bless you for tuning in again. In today's session we are going to start about group accounts, that is advanced financial reporting. But today in session we are going to start for the basic group account. Let's proceed by group account. An entity may expand by acquiring shares in other entities, where one entity gains control over another entity. A parent-subsidiary relationship now exists between the two entities. So because a parent company want to expand their company, it's required to go to the subsidiary company to purchase shares of that subsidiary. Now the accounting rules governing the preparation of consolidated account or group accounts are set out in a number of standards. That's namely where we use IFRS 3 that was revised for business combination, and also we use IFRS 10 or IS 27 International Accounting Standard, which is talk about the consolidated and the separate financial statement. Another rules we are using in a group account, we use IS 28, which is investment in associate, and also we like to use IS 31, which is interest in joint venture. Let's look for definitions in a group account. In this you have to know what does it mean subsidiary. Subsidiary is an entity, it's including an unincorporated entity such as partnership that is controlled by another entity that is known as a parent. Subsidiary is the one company that is controlled by another entity. That company that's controlled that is subsidiary is known as a parent. What does it mean, the control? Control is the power to govern the financial and the operating policies of an entity, so as to obtain benefits from its activities. An example, like parent company, it's have a control to the subsidiary company. What does it mean, a group? A group is a parent and all is a subsidiary. Non-controlling interest, we like to use NCI, is the equity in a subsidiary not attributable to the parent. Previously, this was referred to as the minority interest. When it comes for control, that means the extent to which an entity can control another is essential to deciding the appropriate accounting treatment. Control is normally established when one company owns more than 50% of share carrying voting right of another company. Let's go for this basic group account. When a parent buys a share from subsidiaries, it's required to pay a return, known as purchase consolidation. So if you pay that consolidation, we may require to record. So we have to debit investment in the subsidiary, or can call it goodwill, and also you credit consolidation. The cost of consolidation always recorded at fair value for that you are paying. An example, if you are using a land to purchase the shares in subsidiary, you have to record that's land at the fair value. I have prepared the summary for the beginner. To know this, the parent company want to acquire shares from subsidiary, and the parent asks subsidiary to dispose shares. So parent, it is going to give a purchase consolidation. The purchase consolidation may be in different items. That is going to be in different format as this follow. Purchase consolidation may be cash consolidation, maybe share exchange consolidation, maybe loan notes, maybe deferred consolidation. It may also be the contingent consolidation in cash, or may consolidation in the shares, and also the consideration. It may be asset consideration. So when you are considering to have a shares in another company, there is something you have to pay as a return. That is what you call consideration. Here there is accounting entry we have to record. If it is a cash consideration, you have to debit goodwill, or so you can call it investment in a subsidiary, and also you credit bank or cash. It depends for where you are paying with. In this COVID, you can credit by using Momo Pay. It's somehow different. In accounting entry, if we are using the share exchange as consideration, we have to debit goodwill or investment in a subsidiary, and also we credit share capital as per value. Then you credit again the share premium as balancing figures. If it is a deferred consideration, you have to debit investment in associate, then you credit deferred consideration as a liability. Here, goodwill is going to be debited by present value of all future cash flows. It's required to be unwind. When means unwind, that means that you are compounding. So accounting entries may be required to have to debit the financing cost, and also you credit deferred consideration because it is what the cause of that. So let's look at a small example. There are 100 shares, 100 million shares of subsidiary, and the parents acquire 80 of shares. Let's suppose parents promise to pay $2.4 per share for shares acquired after 2 years, and discounting factor of 10. What you require is to show us the entry, accounting entry, and also purchase consideration of the parent. Let's go for this solution. They've said that the subsidiaries have 100 million shares, and also parents purchased 80%. That means the parents purchased 80 million shares. So the parents promised to pay $2.4 per share for shares acquired. That means we shall take these shares and also multiply with 2.4, we get 193 and 600 million, and also this value is the amount parents is gonna pay after 2 years. So now, because parents is going to pay after 2 years, we need to convert it into present value. My dear friend, please you have to know this because it is more askable in the exam. So as in your question say that discounting factor is 10%. That means we are going to have a discounting factor where we will take value we are going to pay and also put into this in the present value. So that means it's required to have 1 plus I, that means an interest or discounting factor power negative years. This is n, and this is power negative 2, which is 2 years. So accounting entry will be looking like this, where we are going to debit goodwill or investment in subsidiary, which is equal to this value in the present, and also you credit deferred consideration as a liability. As you know, this a promise to be paid after 2 years. It's required financing cost of 10% every year. That means that value we are going to pay in year 1 as a present value, it's required to add on it an interest or finance cost, which is 10%. So that means it is 16 million we have to pay as financing cost. So that's why in year 1 we shall pay 176 million as a payment in the first year. So accounting entry for financing costs, we shall debit financing cost of 16 million and also credit deferred consideration of 16. So that means that value we get in year 1, we are going also to add another financing cost of 10% to get the value to be paid in year 2. So that's why we take this value, the total to be paid in year 1, and also we add with the 10% as financing cost. The financing cost will be 17.6 million. So that's why, as we calculated before, the payments in 2 years will be 193.6 million. So accounting entry will be looking like this. Also, thank you very much. In the next session, I shall show you how to calculate goodwill, where in calculation of goodwill we have 2 methods, where we have full goodwill method and the partial goodwill method. So thank you very much. May God bless you. Stay in touch for Upper Tech TV. Love Rwanda.